Advanced strategies. Putting it all together. All the mathematics you need in the stock market, you get in the 4th grade. Peter Lynch. All you need is one pattern to make a living. Linda Raschke. There seems to be some perverse human characteristic that likes to make easy things difficult. Warren Buffett. I love these quotes. They confirm my philosophy of keeping it simple. I would not bombard you with unnecessary jargon or advanced mathematical concepts. Most often, people who use fancy words are not clear about the concept themselves and hide behind big words to impress. One who really understands can explain in such simple language that even a child can understand. We will not go into 100 technical indicators with fancy names I can't even pronounce. Foundational knowledge of arithmetic, probability, and statistics is enough to do well in this field. The chart patterns we studied in the previous section can be used as is to enter and exit trades. The only reason I have created this section is to emphasize the point of combining multiple aspects we have learned so far into a more robust trading approach. I gave you a glimpse of this when I discussed how you can use volume, support and resistance, etc., in addition to the basic pattern identification. In this section, we will do that in a more structured way and work together through a few examples to grasp the concepts better. This approach of combining multiple factors has been a game changer for me. Let's list down the key components. We have covered all of them in at least some basic detail. Level 1. The must-have. We just can't take a trade without these. Pattern or strategy identification. Do we see a pattern? Do we know the strategy that we are going to apply here? This may seem trivial, but so many times I have seen traders going into a trade just on hunch, as it feels right. There are only a handful of traders who can really pull that off well, consistently. So, for a beginner or intermediate trader, it is highly advised to strictly follow the rules of a particular strategy that works for you. Do not get into a trade until you know what strategy you are adopting here. Stop loss. Do we know where to have the stop loss? As I have said earlier, stop loss comes before you take a position. Risk-to-reward ratio is greater than 2. Is there a good risk-to-reward available? Is the entry point too far from stop? Or is there a major resistance level blocking our way? Or has the stock already run through its ADR? Tolerable risk value. Are we risking an amount we can lose, either fixed amount or percentage of account size? Level 2. Stronger setups. What factors are in favor? Do we have at least 2 more reasons to get into this trade? Volume confirmation. Does volume confirm the expectation? Longer trend alignment. Are we trading along the longer-term trend or against it? Support and resistance. Do we have any key levels? Moving averages, previous day levels, pivot points, daily levels. Other technical indicators. VPA, CCI, Fibonacci retracement, Bollinger Bands, Keltner channels, RSI, MACD, etc. Caution. Do I have 2 reasons to not get into this trade? Usually, this would involve factors like there is a major moving average like 200 SMA or daily or pivot level in our path, so that could act as a resistance. Or if the stock has already moved greater than 80% of ADR, then again, there is a lower probability of further movement in same direction. Unless we are looking for reversal, then this would in fact help. Am I late to enter? Or in other words, am I getting a good entry? For example, if the strategy requires price to move away from mean, like ABCD, or range breakout, then we do not want to enter when we are too far away from mean. We see the pattern on a smaller time frame, and everything fits. But is the trade against the longer-term trend? If yes, then let it pass. FOMO serves no purpose. Market is full of opportunities. We just need to stick to our game. I think it's better to see this in action. It will help register the concept better. Let's discuss the first strategy. Gap fills. If the opening price of a stock is higher or lower than the closing price of the previous day, then we have a gap. See chart here. This is gap up, where the opening price of next day is higher than the closing price of previous day. And this is gap down, where the opening price of next day is lower than the closing price of previous day. To illustrate further, the chart here shows some of the gaps in Amazon daily chart. Here is a gap down. Another gap down. A gap up here. Another gap up. Gaps create a lot of opportunities and are actively looked at by a number of traders employing varied strategies around gaps. The gaps usually create a lot of excitement amongst the traders community, and in this strategy, we take a position in the opposite direction of gap, which is against the position of a vast majority of traders who often take an emotional trade in the direction of the gap. Gap fill strategy takes a counter position. You go long in a gap down and go short in a gap up, so as to fill the gap. The premise of this approach is not only based on the mass psychology of the traders, but is also proven by the win rates when evaluated via backtesting. The premise is that it is highly likely for an asset to fill the gap, provided it meets certain criteria. The criteria are important as they help us improve the win rates significantly. As we are trying to make profits within the day, the key aspect is to identify gaps which have a higher probability of filling within the same day. Follow the pointers below to filter out the gaps to focus on. This is after you have filtered the stocks based on the level 1 filters discussed in the previous section. Average daily volume, stock price, float, and bid-ask spread. 1. We do not want to touch an underlying asset which has gapped up or down with a news. That can be earnings, corporate news, mergers and acquisitions, disputes, etc. If there is active trading in a stock due to a news, which is reflected in pre-market volume, we do not touch it for trading this strategy, as these stocks are less likely to fill the gap during the same day. They may continue to move in the direction of the gap. 2. There should not be any spike in pre-market volume. This indicates that the gap is not due to any news. If there is a small increase, we may still try but with lower risk. But if there is greater than 1.5 times increase in pre-market volume, we will not take the trade. Note that we compare versus average pre-market volume and not the volume in regular trading hours. 3. It's preferable to trade indexes using the strategy, as any noise of a couple of stocks with news is absorbed in the wider portfolio. We can configure this in the stock screener that you use. We set up a stock screener that looks for gaps in major stock indexes like S&P 500 or individual stocks with very high trading volume like Apple, Amazon, Netflix, etc. We also check the pre-market volume. The relative pre-market volume should be less than 1.5x. Combining with a strategy to identify precise entry. I would use the above set of rules to screen the stock or asset to trade, and to identify the direction of the trade. But then, I would combine it with the usual pattern recognition trading strategies discussed in the earlier chapters on a smaller time frame to make the precise entry. Let's look at an example to illustrate this better. Let's list down the key components. Level 1. Must have. Pattern or strategy identification. Gap fill. Stop loss. As shown in chart, we set the stop loss at the pre-market low. Risk to reward ratio greater than 2. As per the strategy, we expect to touch previous stake lows as target, which is almost 4R. But even if we touch 200 SMA, the purple line, which can be a major resistance, we will still have 3R. So, this is good to go in terms of returns. Tolerable risk value. I go with a fixed R amount. Level 2. Stronger setups. We want at least 2. Volume confirmation. Pre-market volume should be usual. Avoid when we have any spikes greater than 1.5x. Note that we compare against average pre-market volume and not regular volume. Support or resistance. We have a support at the moving averages after the 5-minute candle moves across them. Other technical indicators. 5-minute opening range breakout to get precise entry and stop loss. Caution. Do I have 2 reasons to not get into this trade? There is a major moving average in our path that could act as a resistance. There is a possibility to catch 200 SMA before our target is met, but it's far enough for us to realize at least 2.5 to 3R. Has the stock already moved by 80R? Then again there is a lower probability of further movement. No, not in this case. Any other reason to avoid the trade? No. So this trade looks good to go ahead. Here is the recap. I have marked the notes on the chart with numbers so that you follow them in right sequence. 1. We notice that SPY has gapped down. 2. We are looking for a long opportunity that fills the gap with a target of previous day close. 3. The market opens. First 5-minute candle holds above the pre-market low and zips across the moving averages. Moving averages VWAP, 9 EMA and 20 EMA may now act as support. We take the entry at 5-minute opening range breakout. The stop loss is below the pre-market low. 4. We ride the wave all the way through. This 200 SMA can be a strong resistance. So, even though my target was previous day close, I may exit all or 80% of my position size here at 200 moving average. We have already made 3R till this point. Here is another example. Here, all the moving averages are stacked below, and we could see the complete gap fill. 1. We notice that SPY has gapped down. 2. We are looking for a long opportunity that fills the gap with a target of previous day close. 3. First 5-minute candle holds above the moving averages, and we have a 200 SMA support. 4. We take the entry at 5-minute opening range breakout. The stop loss is below the pre-market low. After the price holds above all moving averages, we can add to our position to increase our return on the trade. We exit at our previous day close target. The next example here is interesting, as it indicates the importance of the caution table I use in deciding about the trades. It forces us to think, do we have any major reason to not participate in the trade? In this case, we have a 200 SMA very close to our possible entry, and thus it may not be prudent to enter. And as you see, the decision to stay away was correct as the stock did not reach the target of the previous day close. 1. We notice that SPY has gapped down. 2. We can look for a long opportunity that fills the gap with a target of previous day close. 3. But there is 200 SMA in our way, and we may not get the complete move, as 200 SMA may act as resistance. So, it is better to pass the trade. In the example here, the SPY had gapped up, and we were looking for a short opportunity. We did not get any opening range breakout opportunity on the short side. So, we are waiting for the right moment to enter. At around 1 o'clock, we see an engulfing candle crossing below moving averages. We wait for the ABCD pattern to form to get an entry close to point C. Close to moving averages. Stop loss is just above the moving averages, which may now act as resistance. We see that we have 200 SMA on the path, but it's far enough to realize at least 2.5 to 3R. We exit 80% when the price touches 200 SMA, and the rest when we cross the previous day close. On the 26th of September 2022, when I ran my trade ideas scanner for gap up, RBLX and PDD showed up. See the filters here. Note that you may modify the filters to your preference. Sometimes, you may need to loosen the requirements a bit, but then you should play with lower risk per trade. And then, I checked for news on that day. While PDD had news, RBLX had gapped up with no news. So, I was watching RBLX for an intraday trade, expecting to fill the gap up. So, I am looking to short RBLX. But I wait and watch the intraday 1-minute and 5-minute charts to get better entry. I see an ABCD pattern on the short side. Moving averages may now act as resistance around point C. So, point C can be our stop loss. We take an entry close to the moving average. The price point of $35.48 is our target price, being the previous day close. I would sometimes bail out a bit earlier if we have reached 85 to 90% of my target price. BBKCMIO. This strategy enables us to be ready for a big movement away from mean, using Bollinger Bands, Keltner channels, and momentum index oscillator. As we know that the market spends a lot of time consolidating, this is usually a period of low volatility. It's like the market has been trending up or down for a while and is now taking a breather. After gaining enough energy, it will start the move away from the mean, either to the upside or downside. This strategy ensures we are ready for the move as it is about to take place. Like in many other strategies, and as a principle in general, we want to be in the direction of longer time frames. If the 30-minute chart has fired a squeeze on the long side, there is no reason to go short by seeing temporary movements on the downside. In 5-minute chart, it's worth the wait to find the right signal in the right direction. We covered the basics of Bollinger Bands and Keltner channels in the indicators section. We will get right into how to use this indicator, instead of spending a lot of time explaining the mathematical theory behind this. To screen the stocks for this strategy, we look for the tickers where the Bollinger Bands are between the Keltner channels. This is in addition to the regular filters I shared earlier. Average daily volume greater than 1 million shares, stock price greater than $30, float greater than 50 million shares. See the screenshot here from tradingvu.com. During the low volatility period, Bollinger Bands are closer to each other and may enter inside the Keltner channels. This indicates that the markets are taking a breather and could be building energy for the next movement. This is not a trade signal, but the trader should now be ready for an opportunity. The trade is taken when the Bollinger Bands move outside the Keltner channels. In order to identify if we should go long or short, we look at momentum index oscillator. If MIO is greater than 0, we go long. If MIO less than 0, we go short. Again, note that, like any other strategy, if we just follow this, especially in shorter time frames, we may get a lot of false signals. It is important to combine this with other concepts we have learned, especially on watching the longer time frame. Let's go over the steps one by one. On the chart here, blue bands are Bollinger Bands. Orange ones are Keltner channels. Here, we see the quiet period with Bollinger Bands inside Keltner channels. Here, Bollinger Bands move out of Keltner channels. Momentum index oscillator is greater than 0. So we take a long position here. Stop loss can be at the lower Bollinger Band. Let's look at our table. Level 1. The must-have. Pattern or strategy identification. BBKCMIO. Stop loss. As shown in the chart, we have a clearly defined stop loss before we enter the trade. Risk to reward ratio greater than 2. All moving averages are stacked below, and there is no other resistance level in the path for a long trade. Tolerable risk value. I go with a fixed R amount. Level 2. stronger setups. We need at least two of these. Volume confirmation. No. Would be good to see a rising volume at breakout, but not seen in this case. Longer trend alignment. It is aligned with longer term uptrend. This is visible on weekly chart here. Support or resistance. It is holding above moving average and the upper level of the range acts as support after the price moved across the level. Other technical indicators. BB, KC, MIO, moving averages. Caution. Do I have two reasons to not get into this trade? No clear volume indication or spike when Bollinger Bands moved out of the Keltner channels. There is no other factor. Considering the fact that we do not have a strong point on why not to get in, we can go ahead with this trade. In its most crude essence, this is just a more technical way to identify range breakouts. See chart here. The reason I like this approach is that it does not leave anything to interpretation and defines the criteria very clearly. There is no room for your state of mind to impact the reading of the chart using this technique. Another advantage is that we can easily create an algorithm around this for those who are into algorithmic trading or just don't have enough time to execute trades manually. This technique works really well on the longer-term time frames, but you can use it well even on smaller time frames as long as you are in alignment with the trend in longer time frame. Here is another example. The chart here is split for two time frames. Left one is 30-minute chart and right one is 5-minute chart. The trade is on Apple on the 12th of July 2022. During the day, our scanner alerts us that Apple is trading with Bollinger Bands between the Keltner channels. So, we see that on 5-minute chart and are now waiting for the next step. But before that, we should confirm the longer-term movement. On 30-minute chart, we see the price has moved up away from the VWAP and is facing resistance at the $148.20 level. We can expect it to revert to mean, which can give a good move on the 1-minute or 5-minute chart. So, we are expecting a short trade. Here is the quiet period with Bollinger Bands inside Keltner channels. Here, the Bollinger Bands are moving out of Keltner channels. MIO is less than 0. So, we take a short position here. We can take the entry here and ride all the way down. Zoom in. Unlike the previous strategies that we discussed, this one has a very broad spectrum. It can use any of the smaller setups and patterns that we have discussed in previous chapters. It's not actually one strategy, but a collection of them. Or shall we say, it's an approach in itself. I just use the name Zoom In to represent all such setups as the fundamental concept is the same. In this approach, we start with a longer time frame, identify the key levels and direction of movement. Then we zoom in to smaller time frames and use one of the known strategies to take a trade. I want to bring out the importance of this approach, as it significantly improves your win rate and risk-reward ratio. I have seen traders mostly use the patterns like ABCD, double top, range breakouts, and so on, only on a single time frame, like 1-minute chart or 5-minute chart. They would see the pattern and jump in. In fact, that is precisely how I started out. I learned the patterns and started seeing them on charts and would just take the trade. But still, I would end up having very low win rates. Trades may even go my way for a short while before reversing, without giving me the 2R or 3R return. For a long time, I was clueless on what should I do. What am I doing wrong? I am doing as experts, blogs, and books tell me. Then I discovered the importance of being in alignment with longer time frames. This zoom-in approach ensures that 1. You start with longer time frame. 2. Understand the probable direction and key levels. 3. Then you take the entry based on a smaller time frame. This is the class of trading strategy that I prefer. It helps me get clear direction, key levels, and very good entries for high risk to reward potential. When we trade purely on indicators, the entry is delayed, as most of these are lagging indicators. Since this strategy is a lot visual and involves key levels, there is a higher potential for good entries. Let's understand this from a few examples. I would encourage you to go through all the examples in detail to understand the wider applicability of this approach. Refer the chart here. This is for an IO. The left one is a daily chart, and the right one is a 5-minute chart. I would usually have the charts in 15-minute and 1-minute time frames as well on my screen while trading. But for simplicity and to convey the concept, let's just use these 2 time frames. We are at our desk on 15th morning, preparing for the trades before the market opens. On the daily chart, I noticed that we have ABCD pattern forming on 14th, which is the previous day when there was a bullish green candle closing above the previous candle. I can use this to frame a trade on this day. The 15th. I mark the level, the closing price of previous day, on my chart, so that it shows across the other time frames as well. See the red dashed line. Now, when the trading begins for the day on 15th, I can either watch the chart or set an alert with sound to buzz when the price closes above this level. On 5-minute chart, at around 10:50 am, I see the price holding above the level and volume is rising. I can also see an ABCD pattern forming on 5-minute chart, with level C being just above the red dashed line. The level C on 5-minute chart is shown in black dashed line. I enter the trade with my stop loss at point C. I can then exit when I see the price action losing steam, especially when it starts to fall below the 20 EMA, the orange one. When trading, usually I will not just have one entry and one exit. I would mostly scale in and out of trades, but we will cover that in later chapter. Refer to another example here from Meta. Let's say today is the 9th of June 2022, and we are prepping for the trading day ahead of the market open. On the daily chart, the price rejected a level represented by black dashes on the previous day. That is, the 8th of June. 100 SMA, the green one, acted as a strong resistance on 8th. We had a shooting star on the 8th of June, and that seems to be an important level, as the price had rejected off it 2 weeks back as well. I can mark a level below the low of previous day. See the red dashes. If the price falls below this level, then I could go in for a short trade. When the day starts, I have the level marked, and I am watching the smaller time frames. I know that I am looking for a short trade based on the signal from daily chart. I wait for the right moment based on patterns and levels seen on smaller time frames. At around 10:35 am, I start to see a reverse ABCD pattern forming, and the prices have closed below the moving averages. I can go in now, but if I want to wait for further confirmation, I will wait for the price to close below the red dashed line, and for beta entry, can wait for a slight pullback to have the entry close to the moving average, as shown in the chart. This is the second ABCD pattern, represented by small letters on the 5-minute chart, and the point C almost coincides with the red dashed line from daily chart. We can enter for a short trade with C as the stop loss. That works out great, and we ride all the way down. Here is another example. On the daily chart, we see that the price is operating within a small range. See the marked oval in the chart here. The top level of the range is a daily level, which has been touched a few days back. If the price breaks above, in the direction of longer trend, we go long. On 5-minute chart, the right one, I see an ascending triangle. Hope you remember this from previous chapter on trend continuation patterns. Ascending triangle is forming till 11:30 am on the 28th of July. The top level almost coincides with our daily level. As the price breaks above this and above the red dash line at $40.11, I go long. I have marked these on the chart. Here is an example from Bitcoin to USD. Here, on the left, we have the daily chart, which is largely a downtrend, and we see it consolidating within a tight range for almost 3 weeks, shown by the oval. We have a level marked in red dashes on the daily chart that represents the lower level of the range, which is acting as strong support. If this level breaks, we can go short. When the price breaks below the level, to get a better entry, we watch it on a 5-minute chart. In shorter time frame, we see a double top forming, with the top coinciding with the level we had marked on the daily chart. This is shown by the red dashes. We could enter as soon as the price rejects that level on the second top, or we could wait for the price to fall below moving averages, and we see them acting as resistance. Key question to ask is, how do we decide or find the tickers to watch for a particular day? The selection process for this zoom-in approach is a combination of scanners, both automated and manual. Scanners help us narrow down the search a bit, and then we go through the daily charts of these filtered tickers to identify the ones where we can expect to see some traction on that day. This will come with practice. Initially, the visual scanning may take a long time, but over time, you are able to sift through them in a matter of minutes. So, we start with daily chart. Scanner, level 1. Refer previous section, where we discuss the base filters on average daily volume, price, and float. Average daily volume over 90 days greater than 1 million shares. Stock price greater than $30. Float greater than 50 million shares. Here is a screenshot depicting these filters in trade ideas. Scanner, level 2. Then we would further filter the list based on these conditions. For trend continuation patterns on the daily chart, like ABCD setup, triangle, wedge, etc., we would like to get an entry close to the moving average so that we can maximize return as it starts to move away from the mean in the direction of the trend. So, I filter the stocks where stock price is less than 1% away from VWAP on daily chart, and then I sort them by decreasing order of relative volume and limit the count to top 50. Refer the screenshot, which combines the filtering criteria level 1 and 2 for trend continuation trades. The screenshots are from trade ideas. These are the filters. The image here shows a sample output of the scanner. For reversal trades, like parabolic reversals, double top, double bottom, etc., the opposite is true. You are looking for tickers that are overextended on daily chart and may return to the mean. We can use indicators like relative strength index to identify if the stock is oversold or overbought. The value varies between 0 to 100. A value of less than 30 indicates oversold, and greater than 70 is overbought. We can also filter based on the position in the range that the stock is trading in. I personally prefer this way to scan for extremes that may revert to mean. We may also combine this with relative strength index to get even tighter alerts. This filter basically looks at the stock's price movement of last few days and then gives us the current position in that range. You can change the number of days to be considered in your charting software. So 100% means it is at the top of the range, and 0% means it is at the bottom. So, I would use 0% to 20% to find a probable reversal to the long side, and 80% to 100% for the short side. Here is a screenshot for screener settings to find extended stock on the upside for a potential reversion to mean. Basically, a short trade. Position in last 10 days is greater than 80%. So, this stock is trading near the top of the last 10 days range. Here is a screenshot for the reverse situation. Position in last 10 days is less than 20%. So, it's trading near the bottom of the range. So, we can expect to get a trade on the long side as the stock reverses to mean. Visual or manual scan. Level 3. This is the last stage where you have the filtered list from level 1 and 2. And then, you see the daily charts visually to identify the ones where you see a stronger possibility of movement in your direction. Now, you are scanning through the daily charts to see if you spot a strong pattern, either a trend continuation or reversal. You identify the range or key levels on the daily chart. We covered a few examples earlier, where you saw how the pattern on the daily gave us a reason to watch that particular stock. We also saw examples of daily levels playing out well in the intraday trades. I also like to see the moving averages nicely stacked. So, for long trade, I want 9 moving average greater than 20, 20 greater than 50 moving average, and 50 greater than 200 moving average. The reverse is true for short trades. Once you have gone through this, you should have a very small list of tickers that you are watching. You already have the key levels marked, and you also know the direction you will trade each one of them based on the longer-term trend on daily chart. You can also place alerts on key price levels so that you do not need to keep watching. Before we move to next chapter, another point to understand is this. Why do we need so many strategies? Everyone out there gives you a number of fancy strategies to follow, but then, in the end, they say that don't follow the herd. Build your own. Everyone is different. But why? Why do I need to make my own approach or pick a particular strategy that works for me? The answer lies not in the technicals, but in psychology again. It's not that different people cannot follow the same strategy technically. The difference is in the way your psychology plays out, based on win ratio, risk to reward, and position sizing. These 3 variables are very personal and also vary with the strategy. For example, if I see a lot of red trades, it plays on my mind, and that impacts me a lot. I cannot trade rationally during such times. So, I would usually go with trend trades rather than parabolic reversals. I have a fellow trader who is a lot impatient. He would usually pick scalping strategies where he can enter and exit within seconds. People have had varied experiences in their lives. They come from different cultures. Their parents may have certain ideologies. The family may have lost or gained in business or stocks. Some may have modest background, while others may be affluent. What country you were born and brought up in, during what times. Recession, high interest rates, times of stock market boom, and so on. So even though the circumstances of an individual hardly impact how overall money management or investing works in general, they have a profound impact on that individual, on how to manage his or her money.